Luke Gromen, FFTT. Hope everybody had a great weekend. We had a great weekend here in Cleveland. Obviously, the Browns, it looks like, are going to win. We're going to be 4-1 for the first time in a very long time. Had a fun weekend out at the Ball Diamond, even though my kid did get robbed of a home run by a 20-mile-an-hour wind blowing in from right. But what are you going to do? The baseball gods owe him, so that's a good news. We've also got a little bit of a changed background here. We now, in addition to Mr. X Interviews Volume 1, we have Mr. X Interviews Volume 2. So check it out if you haven't already. I've gotten a lot of good reviews on it. So with that, we're going to jump right into the questions here. First off, from Kim. FinTwit in general seems to believe that gold is going to 5,000, but it will be a horrible world to live in, quote unquote. I know you have the opposite view. Could you elaborate a bit? Yeah, I'd be happy to. I think it is possible. There are scenarios where if we wake up one day and gold's $5,000 per ounce, that it is possible it's there because things have gone very pear-shaped. But my view is a little bit more optimistic. In my opinion, it won't. Gold 5,000 won't be terrible for the world. The world won't be a terrible place to live. And the reason I think that is $5,000 gold means that gold will be big enough. The gold market will be big enough to be able to increasingly serve as a neutral reserve asset to settle trade globally, which means that the primary reserve asset of the past 49 years, U.S. Treasury bonds, will increasingly no longer be the primary reserve asset. And we've seen a little bit of this over the last 7 to 10 years, 7 years in particular, in terms of gold taking share as a reserve asset from treasuries. However, if gold's at 5,000, gold's going to take a lot more share from treasuries as primary reserve asset, which means central banks aren't going to be buying as many treasuries, which means the Fed is going to have to buy them, and they're going to have to buy them with printed money. And so that gets you a much weaker dollar since, by virtue of the way the system worked for 50 years, the U.S. has to run the biggest deficits to supply the dollars to the world. So the Fed will be growing their balance sheet faster than every other central bank, weakens the dollar. And if you get a much weaker dollar, you're going to get stronger global GDP. As remember, part of the bull case of the dollar is everyone's short dollar debt. Well, if the dollar falls, all that dollar debt gets easier to pay. You're going to free up consumer spending around the world as the cost of servicing dollar debt falls. And this is something we saw in 2017. If you remember, the dollar fell 12% in 2017. Coming into 2018, many strategists were admiring the global coordinated growth we had in early 2018. And that global coordinated growth promptly stopped and reversed as soon as the dollar bottomed and began rising again. So ultimately, the reason we think $5,000 gold could be positive is gold would be gaining a lot of share from treasuries. The Fed would have to be buying a lot more treasuries with printed money, weakening the dollar, strengthening global growth. And as the dollar weakens, by the way, you're going to have more onshoring reshoring of manufacturing, etc., which is also a good thing for the U.S. So that's why I say I think people would be shocked by how good the world could be with $5,000 gold. Next question, Iran and the yuan. It came out this weekend that Iran said the yuan is our primary currency now, no longer the dollar. To me, I had several questions on it. To me, this is not a shocking announcement at all. It is probably, at least in no small part, driven by ongoing sanctions that are going on 8 years plus between the United States, that the United States has put on Iran. I would argue there's a little bit of a chicken and egg question in terms of, is Iran moving the yuan because of the sanctions, or are the sanctions on Iran because they've been trying to move the yuan for years? At any rate, two thoughts. Number one, it's going to be really hard for China to run out of dollars to buy Iranian oil if China can buy it in yuan. That's important for the Chinese yuan has to fall because they're going to run out of dollars case. They can't run out of dollars for Iranian oil anymore. And then the second important thing is something we've harped on a lot. I think it's a very important point, is that if the marginal barrel of oil in the world is priced in yuan, which it is, and this is just further proof that it is, then because, as I've said before, as a CFO of one of the biggest trading firms, commodity trading firms in the world, told me 10 years ago, 15 years ago, in commodities, the marginal ton prices the whole. The marginal ton of yuan is priced, or a marginal ton of oil is priced in yuan instead of dollars. Then all of a sudden, if the U.S. wants the price of oil higher, it's got to get the dollar down. And so again, this is something else that I think is an important dynamic to understand how and why that works. Third question from CM. If Biden wins and Republicans hold the Senate, it's possible they could turn fiscally conservative and refuse to play ball on further stimulus packages. How would you see this affecting the dollar, the price of gold, etc.? So the short version of it, I would say, is if that situation plays out, which I think is possible, if it plays out and stimulus is held up, positive for the dollar, negative for stocks, negative for gold, at least in the near term. Basically another scenario like we saw in March. That said, in my opinion, fiscal conservatism is unlikely to last very long once it is pointed out to those same, let's say that the Republicans do hold the Senate and they decide to want to be fiscal conservatives. I think they're going to want to be fiscal conservatives right up to the point where somebody points out to them that the U.S. is either going to have to slash defense spending to make the books balance or to make the math work. And obviously, conservatives aren't going to slash defense spending. Number two, slash entitlements. And conservatives aren't going to slash entitlements because nobody in Congress is going to slash entitlements because that's how you get voted out of office. Or number three, nominally default on treasuries. And conservatives aren't going to default on treasuries. They're not going to vote for that. And why are those the only three things? Those are the big three expenditures. I didn't do that wrong. The big three expenditures. Those big three expenditures are now 140% of tax receipts in the United States in 2020. Just that. Entitlements, defense, and interest expense. And so when you look at that, what you see is those are the only things they can cut that would make a difference if you don't do the stimulus. COVID blew the budget up. Full stop. And so, in my opinion, fiscal conservatism is probably dead for years. There may be threats of fiscal conservatism, but as I said, once they get sat down and said, oh, you want to call the Pentagon and tell them they're slashing their budget, or you want to tell the Treasury market that you're not making the interest payment this month, or you want to tell 70 million baby boomer voters that you're cutting their benefit, it's not going to happen, in my view. So that's why I say I think any threats of fiscal conservatism from either side are, to me, likely to be very brief at most. Third question from MC. Seems like we're heading for a big shift from monetary to fiscal stimulus or fiscal policy. Do you think this creates the potential, for real growth and the value rotation resulting from higher real rates? So I agree we're heading for a big shift. I think it's already underway in the early innings of a shift from monetary driving the boat to fiscal driving the boat, with that difference just being instead of the Fed driving the economy, it's basically U.S. fiscal spending monetized by the Fed. I don't know that it'll drive real growth if we define real growth as growth in excess of inflation. I don't think that that's likely to happen. I think the playbook here is nominal growth. And that's all you need. When you've got debt to GDP at 135% at the federal level in the United States, it's no longer about real growth. It's just drive nominal growth, and then the Fed will pin yields wherever they have to pin yields by growing their balance sheet. And basically, U.S. Treasury holders are going to be stuck with the bill. So we saw this in the aftermath of World War II. The last time U.S. federal debt to GDP was this high, we saw nominal GDP growth ran 500 to 800 basis points above the nominal yield on 10-year U.S. Treasury bonds for the better part of 35 years. And basically it was a long-term thank you for your donation, Treasury holders, to recapitalize in the United States. In that time, debt to GDP went from 100% plus back down to about 30% by 1980. The long-winded way of saying, I think it could bode very well for certain value names. I think industrials would benefit from this. I think they've maybe started to see a little bit of this. I still think big tech works, even though that's been sort of a growth/duration trade. And positive real rates, I don't think is happening for a long, long time. Now, could it happen for a brief period of time? Sure. And that's going to be an environment where you want to own dollars and basically nothing else. But again, positive real rates will force the United States to either slash defense, slash entitlements, or default on treasuries. And none of those three things are happening. And so the Fed will, in my view, move heaven and earth to keep real rates negative for a long time and probably increasingly negative. So that's the last point there. And then the last question, had a number of people ask me about the outlook for precious metals as well as stocks into year end. And The answer here is it's intellectually offensive, but I think it depends heavily on fiscal stimulus, and I think it depends on the election outcome. And if we get the stimulus, I think you have to have a positive outlook on precious metals and stocks. And I think if you don't, then I think it basically is the beatings will continue until morale improves. In other words, dollar up, precious metals and stocks down until Congress can be convinced that they need that stimulus. Now, to me, I thought it might be very instructive given what we saw last week, which is President Trump said no deal at 3:54 p.m. And by 6:54 p.m., he was tweeting out basically crying uncle. I'm willing to talk. I'm willing to send $1,200. I'm willing to do the airline deal. Please call me Nancy Pelosi. And I think that's simply because he saw what happened to stocks. He saw what happened to the dollar. He saw what happened. Stocks, I think, the big one. So stocks effectively are the economy now at 160% of GDP in terms of total equity market cap and for other reasons we've discussed before. So I'm going to leave it at that. As always, check us out at FFTT-LLC.com for what we're up to and future appearances. And if you like these updates, please check out FFTT Tree Rings. It's a 10 most interesting things piece that we put together every Friday for our subscribers. 10 most interesting things we've seen, a synopsis, ties together a lot of different pieces on a real-time basis of what's happening every week. So if you like these periodic updates, you're going to love Tree Rings every Friday afternoon. So check that out. In the meantime, everybody have a great week. Everyone stay safe out there, and I look forward to chatting with you soon. Take care, everybody. Thanks for joining.